Hi, my name is Hugh Bullen and I'm a mortgage broker in Calgary with DLC Elevation Mortgage, and I'd like to talk to you a bit about variable rate mortgages and why I still think they're the pick over a fixed rate mortgage, even though everything we read in the news might make you think otherwise. So what is a variable rate mortgage? Well, it is exactly what you think. The interest rate varies depending on the Bank of Canada and their interest rate decisions. Now, there are two types of variable rate mortgages. We have the true variable, and then we have adjustable. With variable, the payment remains the same. It's a static payment. If rates go up, you pay a bit more towards interest. If rates go down, you pay a bit more towards principal. Now, with an adjustable rate mortgage, the payment will actually go up or it will go down if rates go up or if rates go down. Now, most lenders have an adjustable rate mortgage, although there are some that will do a variable. So if that's the way you want to go, we can certainly send you there. So what is your interest rate there, and where does this all lead back to? So the interest rate that you have is your lender's prime rate with a discount on that prime rate. That discount is what you have for the duration of your term. Now, the prime rate, I'm sure you've heard of it, but it is kind of the rate that the lender will base all of their sort of lending on throughout the company. So you'll hear prime plus, let's say, on a line of credit, or prime minus a certain percent on a mortgage. Now, prime is what moves depending on the Bank of Canada and their interest rate decisions. So you have prime rate, you have your discount, and then we have the overnight rate from the Bank of Canada. So the overnight rate is an interest rate that the Bank of Canada uses to either stimulate the economy or cool off the economy, depending on if we're kind of heading into a recession or we're in a moment of inflation like we are now. So I'm going to rewind a little bit back to about 2009, 2007 really. I'll go back as far as then because that was the last kind of big recession that really affected the whole world. Now, the overnight rate was 4.5% and the prime rate was 6.25%. At that point, it was still really a lower interest rate. It was, kind of at that point really low in history, but it's still a decent rate. And the financial crisis hit and they had to lower rates, obviously to stimulate the economy and help out citizens and get people spending. It went all the way down to 0.25%. Prime went down to 2.25%. And it stayed there for a little while. It creeped up a bit, it went down a bit, creeped up, it just sort of stayed in that sort of lower area. And then in about 2019, we went up and we were at 1.75 for the overnight rate, and we were at 3.95 for the prime rate. And it stuck there just for a little bit. And bear in mind, that was still sort of historically low as you look back through the history of all the way back with prime and the overnight rate. Still very low. The pandemic hit, rates sort of plummeted. They went down again to 0.25% for the overnight rate and 2.45 for the prime rate. So people in variable rate mortgages, they had this very low rate, and we've been down in that sort of area for a couple of years now. And with that low rate, it has of course stimulated the economy and the housing market. We've all heard of this in Toronto and BC, of the housing market really taking off, and it has done in Calgary in recent months too. And with that, and with global supply chain pressures, other things happening around the world, inflation is creeping in. It's creeping up bit by bit, and it's above the target that the Bank of Canada wants. So, one of the measures or one of the tools that they have is to rise the rates again. So right now the overnight rate is at 1.5% and the prime rate is at 3.7%. And as we look back, and I sort of mentioned those rates before, it is still very, very low, and it's actually lower than what it was before the pandemic hit. So I just want to put that into a bit of context. Now, as we look at that and we look at all these graphs, we can see that a recession hits, let's say, rates go down, people start spending, inflation goes up, rates go up, and then as rates go up, kind of another recession hits, rates go down again. And what we're seeing now, and if we look at the graphs and what really everyone's expecting, is rates are probably going to go up again in July. Could be half a point, could be 3/4 of a point. They might follow what the Americans just did yesterday. And if that's the case, rates go up a bit, it's going to cool off spending. And the hope for them really is that it will slow down inflation and might pop us into a recession, which again, if we look at these pieces, it will bring the interest rates down again. So with all of this, the key is to remember that a variable rate mortgage, rates go up and rates go down, and it is a long-term strategy. And historically, variable interest rates are about 2% less than fixed rates. That's quite a big difference. A little bit less than 2%, but it's around that. Now, if we look at that and we think, well, rates might go up a little bit, but they'll come down again, you just have to be prepared for them to go up a bit and go down. Now, there is a strategy that we have with a variable rate mortgage, and that strategy is this. This is more for an adjustable rate, but increase your payment by the maximum that the lender will allow. Some are 15%, some are 20%, majority of lenders are 15%. And increase your payment by that much, and then every month a little bit more goes towards principal, and you actually pay down your mortgage sooner. And then as rates rise a little bit, you do shelter that increase in there, just a little bit more goes towards interest. Now, is there a point where it might go up above to even what the fixed rate would have been? It might do, yes, but the likelihood of it coming down is also pretty much certain. The other difference of a variable over a fixed rate, which I think is very important for people to really take into consideration, is your payout penalty. So if you break your mortgage in the first 5 years, or within that term, with a variable rate mortgage, you only have 3 months of interest. With a fixed rate mortgage, it's the higher of 3 months of interest, or the interest rate differential, which is kind of a complicated calculation that they use to figure out the loss of interest for the remainder of the term. It can be very, very, very high. I had someone last year with about $430,000 owing. It was a $12,000 penalty. Now, had that been variable, it would have been about $1,500, $2,000. So not that sort of doesn't inhibit selling that much. So that's something to consider as well. Is the rise in rates and maybe a bit of uncertainty there a concern to you, or is the certainty of a very high penalty if you move, is that more concerning? For me, and I think you'll find for every mortgage broker out there, that is a big concern, and variable is where they think you should go. Well, I want to give you a quick example of a payment and the difference as we sit today between fixed and variable, and I think you'll see that the argument is to go with variable and increase that payment. Know that it might go up a bit and then it will likely come down. So the average house price in Calgary is approximately $520,000, let's say. Now, if you put down the minimum down payment, which is $20,000 in that property, I'm not going to borrow you a down payment, but 5% on the first $500,000, 10% on that $20,000 makes $20,000. On a variable rate mortgage, your payment is $23.16 per month. On a 5-year fixed, it is $28.96. Now that's a $580 difference in the payment, which I think is huge. So you have to ask yourself, am I comfortable paying $580 more every payment for the next 60 payments? And I'm happy paying that much more for the stability of a fixed payment? Or do I want to take that lower payment for now, know that that lower payment might creep up a little bit, might kind of match what the fixed is, might go up a little bit and then will likely come down? I'll take that any day of the week. Now, the difference in rate between fixed and variable is about 2%, a little over 2% as I make this video. And so that's going to take a few more increases from the Bank of Canada to match what the variable is with the fixed right now. So that's another reason I really think the variable is the way to go. If you have any questions on this, please feel free to give me a call. I'd love to explain this to you in more detail and hopefully explain the reasons a little bit more. Have a great day.